Welcome to Retirement DNA Podcast. I'm Duane Johnson. We believe you deserve financial advice based on your best interest. In our podcast, we'll discuss all aspects of retirement planning. And today we have a special guest with us, Valarie Lukacsy. And Valarie just happens to be our tax person in our office. And she also happens to be my sister. And when we talked about in the beginning of our first podcast that we truly are a family business. So what we really want to do is sit down, talk to Valarie today and ask her some questions. So hopefully we can get some better understanding about taxes and what taxes really mean to you. So welcome to the show, Valarie.
Thanks for having me.
So let's get started. Well, first thing I really want to ask you is, why did you get into doing taxes and what brought you to the Duane Johnson Group?
About 15 years ago, I started with another company, mostly doing bookkeeping at the time, but they did taxes. And, I kind of found it interesting. But then I also had some rental properties. And when I sold one of those rental properties, I was very surprised to find out that I owed more than just capital gains. And this confused me, and it just kind of piqued my interest. And so I started researching and talking to her about why, it's like I thought I was 15% capital gains, done deal, this is it. And so I started learning about, recapture depreciation and stuff like this. And I found that, this is really interesting. It's kind of like a big puzzle. And I kind of enjoyed it. And I also really enjoy working with people, helping them understand their taxes, hopefully getting them the best tax outcome they can have without, breaking rules. And that's what brought me to that. The reason I'm with the Duane Johnson Group is Duane said he's my brother. And he was often calling me with questions while I was still at the other company with, hey, what about this? What about that? And eventually it came that, it was kind of time for me to move on. And it just worked out that it would be great to have a place where people's financial planner and their tax person was in the same office. And so that way we could really get to see the whole picture. And he would call me, or I could actually sit in front of people and give them, this is what's going to happen if you do this, or what this would happen with that. And so it just worked out that Duane and I were able to work together, and it's been great. And now Aaron's joined us, and this makes it even better.
Well, let me ask you this. You're an enrolled agent. Can you explain the difference between what an enrolled agent is, a CPA, and just a tax preparer?
Okay, well, I'm an enrolled agent, and what that means is I have been recognized by the IRS as able to prepare taxes. I can also represent you in front of the IRS if need be, which let's hope it doesn't need to be. I have taken tests, and it's just the highest credential awarded by the IRS. CPAs are different, they're more recognized by the states. They may or may not have the as much into the taxes, where some of them have been more into the taxes, and others are more like into audits and stuff. So it just all depends. A tax preparer, on the other hand, some of them have just all you really have to do to be a tax preparer with the IRS is get a P10. That means you just go in, you sign up, and you've got it. Now, the state of California is one of the few that actually makes tax preparers get what's called a CTEC. So they do take some classes, and some continuing ed every year, where as an enrolled agent, is much more stringent, the continuing ed. But, when you be aware of the tax preparers, especially in other states, make sure they have some credentials behind them, I would recommend.
Okay. Well, as you know, Aaron and I, we do retirement planning. And I guess one thing people would probably want to know, how important is tax planning to an overall retirement plan, and why is it important?
I would say it's very important to know, what is your taxes going to look like when you retire? Are you going to have tax-free income? Is all your income going to be taxable? What are your plans? The hard part with this is we're up against an unknown. We know what the tax laws are now, and we have no idea. Like you've seen in the last few years, it's constantly changing. So you want to plan as best as you can and kind of look at, hey, what can I do to make sure maybe I can get some of my money a little better off than it is right now when I go into retirement.
Okay. Well, are there any changes in the tax code for 2019, 2020 that people should be aware of that may affect them?
Really, right now, we're in a pretty good tax situation. 2018, we saw some sweeping changes, as I'm sure most of you noticed. For the most part, 2019 and 2020 are going to be very similar. The interesting thing about when you ask that is you think that the tax laws are already written, but the truth is 2019 tax laws aren't even done yet. In fact, there's been years where in January, even as late as February, there's been some tax code changes that were retroactive to the prior year. So things are constantly changing, but for the most part, things are the same. The one thing I would like people to be aware of, though, is as the interest rates have gone down, I've been getting calls from a lot of clients saying I'm refinancing and they need their tax returns or whatever. When you refinance, you got to be aware that not everything is going to be, all the interest is not going to be tax deductible any longer. If you take out money that isn't solely to repay what would be considered original purchase loan, like you take out to buy a boat, you take out to buy a car, you take out to go on vacations, pay back credit cards, etc., that interest on that loan is not going to be tax deductible at the federal level any longer. So you're going to need to keep track of how much of the money went where and bring that into your tax preparer when you come in.
Okay, so what are some of the ways that people can protect their assets from taxation?
One of the best ways, of course, is right now we have is the IRAs, if you're a working person. You have your traditional IRAs or your 401ks and stuff like that, but that's tax deferred money, meaning that eventually you're going to pay taxes on that. The other one, great thing, is the Roth IRAs. Those you pay the taxes on now, and then later when you retire, you get that money plus all of the growth on that money tax-free. The other unfortunate way, but one of the best ways, is the inheritance. A lot of if you pass money on or pass assets on, a lot of that can be passed on without any tax consequences. I would say that's why it's very good to talk to someone like George, who is in our office, about having a living trust and those kind of things, because that is one of the great things our country still offers for tax purposes.
Okay, I'd like to spend a little bit of time on this next question I have, because I've had rental properties myself and have sold them. And when selling a primary home or rental property, how are taxes calculated? Because that's one of the big misconceptions we have a lot of times when we're talking to people in our appointments.
It is. A lot of people are very confused about how taxes are calculated on primary homes versus rental properties. Let's talk first about a primary home, because it's very simple. First of all, a primary home is the one that you've lived in at least 2 of the last 5 years. And if you meet that, you have up to a $250,000 gain or a $500,000 gain for $250,000 for a single person or $500,000 for a married couple of income you can not pay taxes on. A lot of people are confused about even this. That doesn't have anything to do with what you owe on the property. It's what you paid for it, meaning your basis. So let's say, for instance, you bought this property for $200,000. You back in 2020 or 2002, and you're selling it this year, and you're selling it for $650,000. You have a $450,000 gain. If you're a married person, that is completely tax-free income for you. Now, for a rental, it's a whole different situation. When you have a rental property, you have to take depreciation. It's not a matter of, well, I don't want to have to do that because I want to have to don't want to have to recapture it. The law is what you should have or did take in depreciation. And when you sell those rental properties, the first thing you do is you recapture that, meaning it becomes ordinary income. All the depreciation you took is now considered ordinary income. And then on top of that, whatever you sell it for above what your basis is, meaning kind of a weird calculation I'm not going to go into, there's capital gains on that. So rental properties are taxed. For most people's primary homes, they do not see a tax consequence when they sell them.
Okay. Can you maybe explain what step-up basis is a little bit more?
Okay, stepped up basis is inheritance. That has to do with an inherited property. Is that what you mean?
Yeah.
Okay, so again, this is where you can avoid some of these taxes. Let's say you have a parent or someone who has had a rental property forever. And, I've seen people who have had these after 27 and a half years, all the depreciation is used up. So essentially their basis is down to zero, meaning everything's going to either be taxed at ordinary income levels, back up to where they purchased it, or capital gains. But what happens when this person passes and whoever inherits, they get what's called a stepped up basis. And that means their new basis in it is the value at the time of death. So as long as they're under whatever the inheritance tax laws are at that time, under that value, which is a lot right now, they wouldn't pay taxes on it. Or if they choose to keep it, they would, if they keep it for 3 or 4 years, they would only pay taxes on whatever they gain in those 2 or 3 years. So that is one of the ways that you can plan for saving some taxes on money, as long as you decide, kind of plan ahead, talk to your family that, we're going to keep this, we're going to live off the income, and eventually the children or whoever is going to inherit will get that at a much better, pretty much tax-free.
Okay. So let's kind of move into a little different category here. When Aaron and I meet with people, we talk a lot about, and even in our seminars, we talk about IRAs and Roth IRA conversions. And maybe you can help us. Why does it make sense to convert an IRA to a Roth IRA, and when would it make sense to do that?
Well, the reason, first of all, is going to go back to what the difference is. An IRA, a traditional IRA, and those are your 401ks and all those things, for the most part, have been what we call is tax deferred, meaning you haven't paid taxes on them, but you're going to. So when you take those monies out, all of it's going to be tax, even if, and that's one of the few places where if someone inherits, that money is still taxable to whoever inherits it. Where a Roth IRA, you don't get the tax benefit, you don't get to write it off, you pay the taxes on that money when it goes in, but all of that growth is tax-free, meaning you don't have to pay taxes on anything when you take it out. It gives you a lot more flexibility to have those Roth IRAs, because a traditional IRA at 70 and a half right now, you have to start taking money out of them. For a Roth, if you don't need it, you don't have to take it out. So when would it make sense to convert it? You got to know where you're at tax-wise and what you think you're going to be at in your retirement. When you're at a lower tax bracket, that is when it would make sense to do the conversion. Right now, though, we're kind of in a unique situation where we're seeing some of the lowest tax brackets we've seen in years. And so if you are at the bottom of your bracket and you kind of know, what, this is going to be about the same bracket I'm going to be in for the rest of my life, it might be worth taking out the money up to the next bracket. So for instance, let's say you're at like $80,000 for a married couple of taxable income. Well, that's the 22% bracket. You could go ahead and take out like another $80,000 before you're in the next bracket, which is about $168,000, and it's still going to be at that 22%. That way and just convert that to a Roth. That way you are guaranteed you're paying the 22% on that money. You aren't going to be forced to take that out when you don't want to and have to pay the taxes on that. So right now, I would say we're kind of in a unique situation where you really want to kind of consider where your tax bracket is, where you're at in that. And again, I can't guarantee you what's going to happen in the future, but I do know from the past, this is the lowest rates historically we've been in years and years. You might want to consider taking advantage of these great rates. The other thing, while I'm thinking of this, I kind of want to explain to people, a lot of people have a misconception about these brackets. They think that if you go over at all, everything goes over. And the way the bracket works, if for simple sake, let's say that you're in the next bracket's $100,000 and you take out $101,000, only the $1 is at that extra tax, not the whole $100,000. So a lot of people are very concerned about where that next bracket is. it's not all of your money that gets into the next bracket. It's just the money over that.
And you're right. I'm glad you brought that up because that is kind of one of the big issues or misconceptions people have too when we talk to them. But we'd like to thank you for coming in and talking today, Valarie, and taking your time to do that. And as you can see, tax planning is a very important part of the planning process when you're doing a retirement plan. And our main goal is to make sure our clients know that they can make it to and through retirement so they can spend with confidence during those years. And we want to make sure they have financial security in any economy. So that's all we have for you today. And we thank you for listening to Retirement DNA podcast today. If you have any questions or would like to sit down with us for an initial consultation and see if you're on track to meet your secure retirement, please give us a call at 951-244-6702. Again, that's 951-244-6702. If you like what you've heard today, please subscribe to our bi-weekly podcast, and please tell your friends and family if you think that they would benefit from hearing this information also. Also, check us out at DuaneJohnsonGroup.com and BridgerFinancialServices.com. Again, thank you for listening and have a great day.
Investment advisory services offered through Bridger Financial Services, LLC, a registered investment advisor in the state of California. Insurance products and services are offered through Duane Johnson Group, LLC, affiliated company. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Duane Johnson Group, LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Duane Johnson Group, LLC.